Hi everyone, welcome to this training video on currency correlation. It's going to be our focus today. I want to thank you for taking the time to watch this video, and hopefully you'll find the information provided here useful. I'm going to start off today by talking about what a currency correlation is. That's the basic foundation for what we're going to be talking about today. And simply put, a currency correlation is currencies moving in line with one another or correlating to move in the same direction. It's a way to use a currency as a leading indicator for another currency. And in Forex, for some reason or another, it's not something that I've heard a lot of traders talk about. There's a lot of talk about technical indicators, but there's not a lot of talk about using currencies to indicate where another currency is going. And I find it to be one of the best leading indicators because you're not analyzing history, which is what all technical indicators do to predict the future. You're looking at current market movement and basing pairs movement off of current movement of other pairs. Now, to understand this and why it happens and how it works, you've really got to get down to a place where you understand that every currency affects every other currency. And the reason for that is that we're in a worldwide marketplace. So everything affects everything else. When there's huge amounts of money flowing into a country or flowing out of a country, it has an effect on every other currency. It has to. So what you really have to do is you have to get down to the main currency that's driving the markets. And what is that currency that's driving the markets? And that currency that is driving the markets, from what I've seen, is the U.S. dollar. The U.S. dollar is the main currency in the world. It's still used more in any other country than any other currency is at this point in time. Is the most widespread currency, and it is what a lot of importing and exporting business is still done in to this day, is U.S. dollars. And because of that, the U.S. dollar tends to drive the currency market. Now, I'm not just going to make a statement like that and not show you an example of what I'm talking about. Now, don't let me get you wrong either. You can't discount the fact that every currency does move the market. All right, during times of economic data and fundamental events that are taking place within a country, the currencies definitely will move, and they will move regardless of what the dollar is doing. A good example of that in recent times would be this big decrease that we've seen in the euro and the pound over the last couple months, where we've seen this fallout on the euro from the 160 level all the way down to about the 139 level. And that fall was based on a couple of factors. One was dollar strength. Another was European weakness. The EU is having a lot of economic issues, and they're in a recession. And because of that, the euro weakened. So that extended that move. And so there's a little bit of both factors involved in that move, because you have the U.S. dollar strength and the weakness of the eurozone as well. But there is certainly the ability to move the market on any currency. Okay, if you're looking at the pound U.S. dollar, it's not just the U.S. dollar that moves that currency, it is the pound as well. But there is no question that during a normal trading day, in my mind, in a normal trading day when there's not an economic event driving the market, and there is no economic woes or turmoil in the country, or any risk aversion taking place, and we'll discuss that in a later session, that the dollar is the main driving force. And we're going to show you that right now. We're going to go look at a couple different pairs here, and we're going to show how the dollar is the main factor in the currency market. Now, as you can see on this chart right here, we have a US yen pair, we have the pound yen, and we have the pound USD. So what we're looking at is two pairs, both crossed with the US dollar, and then we're